have to take this opportunity to share one of my favorite things to say to family and friends when thinking about the stock market, especially particularly over the long term, that 5 to 10 year horizon. That's where you really see the magic in the market. And the reason I call it magic is because over horizons that long, the market is really not risky. And you can, if you actually Google, say, the S&P 500 and look at the Wikipedia page, it'll show you the rolling 10-year return of the S&P 500. And so what a lot of people don't realize is with a horizon that long, a lot of the oscillations that you'll get in the shorter time periods, all that kind of averages out, and you end up getting a really narrow, much more narrow set of outcomes in terms of investment. So yeah, I just wanted to share that because that's kind of a barbell where that's where you have the least amount of risk. But then the most amount of risk is obviously on that shorter horizon, but that also creates more opportunity for alpha when you have that shorter horizon. So it's that's how you frame the investing landscape, and then you kind of pick which sandbox you really want to play in.
Let's say those that in fact would like to just put something to work and essentially get some sleep at night. How ultimately do they make sure that they are able to receive some of the alpha that may well be generated, along with having the protection for whenever that flip happens, which of course no one really knows?
Yes, and that's another great question, Pamela. And the answer, and this will be quite intuitive, is balance, right? Yeah. How do you navigate the water such that you can survive during the choppy moments, but then also the smooth ones? And in practice, in factor space, that you do that is you take a balanced approach to the building blocks you're using for your client portfolio. So basically what that translates into is, a mosaic of value, quality, and momentum. And you can even, throw a low vol in there. And, even something as naive as just equally weighting those will allow you to participate in some of that shorter term alpha opportunity that I talked about, but then also be able to weather on the back end of that some of the growth headwinds that we're likely to see in the coming year. And so, Fidelity Canada offers several factor balance portfolios. And so, that's one way, to sleep at night, the set it and forget it. I call approaches like that the golf portfolio. Set it and then go have fun with your day. So
I like that a lot. When we discuss, and we have discussed this before, the reopening, and there's lots of different areas within that I think we all thought that reopening would mean maybe a lot more air travel, or perhaps a lot more, other things that are snapping back. There seems to be much discussion around a recovery delayed. How does that work when you're going through different factors? What sort of how can you apply different strategies to, again, perhaps capture that? It might be slower, but ultimately is still coming. How do you look at that?
Yeah, that's a great one, and that gets into what's priced into the market, which you kind of asked that question earlier. The challenge there is the reopening story is something that it's a narrative that's been around for a while now, and so a lot of that the alpha from investing in those sorts of companies was accrued earlier in the year. And what happens is once if you still have that narrative, but it's now being delayed or elongated, I'm seeing that with my office here in Boston, where we were contemplating going back, say, September or October. Now, realistically, I think that we're probably pushing it out into 2022. Given that the market kind of prepaid for the outcome of reopening and the economic activity or increase in economic activity that's associated with that, what happens then is that for individual companies, their estimate revisions end up getting revised down. And that's the most powerful driver of stocks and factors is estimate revisions and what's happening to the revisions of any basket of stocks. And what happens is when they are going down, that basically means you need to be this defensive while that's happening. So buying higher quality, growthier companies that have, recurring revenues, that kind of thing. And while you wait out those downward revisions, and then you can kind of get back in and have the opportunity to the upside once economic activity reaccelerates and you actually do get the proper reopening that everyone was anticipating. There are a couple of ways that factors allow you to participate in this. Now, in the purest sense, with going back to this reopening trade, it's usually the beaten down companies that do the best when you have that reopening environment. And the way that gets expressed in factors usually is within value. You're buying cheap stocks relative to their fundamentals. And then what happens is those cheap stocks end up growing earnings faster than anybody anticipated, which was actually what we saw for the most part of this year. But then, once that's been playing out for a while, you actually do transition. The best way to leverage that or participate with that would be in momentum, because momentum is then kind of starting to pick up on what's working. Stocks who are cheap fundamentally, but things are getting better. And so as it turns out right now, that's one of my favorite ways to participate in that right now. It's kind of a combination of the two. But depending on where you are in the economic cycle, again, once you get into the later stages, late and then recessionary, that's where it's really all about defense. People, I call it the flight to quality, where people are most concerned with capital preservation. And so, I say this oftentimes internally, it ends up being quality at any price. Like, no one cares about proving fundamentals or anything. Just give me the lowest beta thing that I can buy. And quality and low volatility factors are ways to capture that theme if that's where you're focused on and you're in the right part of the cycle that's advantageous to do that. The way I think about dividends is that right now, again, is a unique environment to invest in dividends that you don't get very often. So if we just talk about history for a moment, you're right. There are companies who had to cut back, and this is every recession. That's just the way recessions work. Companies have to cut back on their dividends. And so their yields and payouts end up declining. Into an economic recovery, when you look at historical patterns, those companies end up, the best time to buy those dividend yielding companies or dividend paying companies is when the economy is starting to normalize. And you're kind of in that similar environment now where the banks, many of the US banks couldn't pay or had limits to what they could pay. You had energy companies that, for obvious reasons, when with oil down at $35, had to cut or suspend dividend payments, and now they're being able to pay again.